terminology relating to income tax. So these basic aspects we have covered. Not only the basic aspects, we have also learned the clubbing of income and so now we are going to enter into a very crucial part of the income tax, which is how to compute the gross total income, because the tax liability is computed based on the gross total income of the SSC. Okay, the tax liability is calculated on the gross total income of the SSC. So it is necessary for the SSC that he should know how to compute the gross total income. Okay, I will share my screen and I will show you the computation process of the gross total income. Okay, this is my screen. So we have more clarity. I believe the screen is visible. Okay. So see, a SSC can have income with income through different sources. Okay, a SSC can have income through different means through under these 5 heads. Basically, under these 5 heads, the total income is computed basically under these 5 heads. Okay, they are being aggregated under these 5 heads. A SSC or an individual can have income from salary, income from house property, income from capital gain, income from business profession, and income from other sources. Okay, so already these things we have covered in our previous class. Okay, the 5 heads of the incomes. What are the primary heads? What are the 5 heads under which the income is computed? So these things we have already covered in our last class. So these are the 5 heads which are the main means of income, which are the means of the income for the SSC. Income from salary, income from house property, income from capital gain, income from business and profession, and income from other sources. When I say other sources could be the lottery, income from lotteries or income from prize received. So all such incomes comes under the income from other sources. Now, see, the total of the whole is called as gross total income. Okay, if we sum up income from various means, income from salary, income from house property, income from capital gain, income from business profession, income from other sources, if we sum up all, it gives us gross total income. So the SSC will be able to understand, he will be able to know the gross total income. Now, the tax is not computed, the tax liability is not, the tax liability doesn't prevail on the gross total income. Still, we have certain adjustments. Okay, so we will clubbing of income will be done. Okay, some adjustments are there. To this gross total income, we will add all the incomes. We will club off all the incomes. Like I told you, sometimes the SSC can transfer the property in order to reduce its tax liability. So if such transfers are done, so if any such transfers are done, so that transfer will be considered in the total income of the SSC. Okay, and the SSC will be burdened. SSC will have the burden of bearing this tax. Okay. So once the gross total income is derived, we will club off all the incomes. Like I told you, one simple example. Sometimes the SSC transfers his property without any consideration. It means the transfer itself gives the motive that the SSC wants to reduce his total income. In such case, the government has designed a mechanism of clubbing of income. So that the SSC is not being able to avoid his tax liabilities. So even though the rent has been received by the spouse or the wife, still the rent which has been received by the spouse will be considered under the income of the other spouse, that is husband. For example, if wife has been receiving the rent of the house, still the rent received by the wife will be considered as income of the husband itself, and and it will be summed up. It will be summed up in the gross total income of the husband. Okay, because this transfer, the method of transfer itself gives the motive. The motive is to reduce the tax liability. If husband is transferring his property without any consideration to the wife, the mean of transfer of this property itself defines the motive of the SSC, that the SSC wants to avoid his uh, reduce his taxable income. So whenever such thing is whenever such motive is found, the SSC has to bear the tax liability. Okay. Now then we have set off and carry forward of losses. In the last class, we have learned about set off and carry forward losses. See, basically this is a mechanism for fair taxation. Okay, so that SSC is not overburdened with the tax liability. Okay, so to reduce the overburdening of the SSC, this concept we have set off and carry forward losses. For suppose if SSC has a loss, okay, loss in the previous year. For suppose if SSC has a loss of 2 lakh rupees in the previous year, and this year SSC has a profit of 3 lakh rupees. So the losses that he incurred in the previous year will be neutralized with the income that he is making this year. So for suppose if the SSC has incurred losses of 2 lakh rupees in the previous year, then in that case, and for suppose if SSC has incurred profit of 3 lakh rupees this year, so he will not have to pay tax on 3 lakh rupees. He can reduce his tax liability by setting off these losses. Last year, he has incurred a loss of 2 lakh rupees. This year, he is incurring a profit of 3 lakh rupees. So he will not have to pay tax on the income of 3 lakh. He can set off the loss that he has made in the previous year. So this year, he will only have the liability of 1 lakh rupees. He has to pay tax on only 1 lakh rupees, not the entire 3 lakh rupees that he is making. Okay. So this mechanism is there. So all these adjustments are done. Okay. So after clubbing of all the incomes and setting off and carrying forward all the losses, we derive the adjusted gross total income. Okay. We derive the adjusted gross total income. Now on this adjusted gross total income, students, in order to understand this adjustment classes, you need to hear it once. Okay. My previous classes wherein I have covered clubbing of income and set off carry forward of losses, that you should go through once in order to understand these adjustments. There I have covered everything. Okay, what is called clubbing of income and what is set off and carry forward of losses. Clubbing of income is something where the SSC cleverly transfers his property or income just to reduce his taxable income. Okay, so that is clubbing of income, and this has been covered in my initial classes. Clubbing of income is there, and in my last class I have covered set off and carry forward of loss. This is to neutralize and not to overburden the taxpayer. Okay, if we don't do set off and carry forward of losses, it will be as like burdening the taxpayer. Okay, so just to not overburden the taxpayer, this set off and carry forward of loss mechanism is there. Okay. So if somebody has a loss of 2 lakh rupees previous year and income of 3 lakh rupees this year, so he will not have to pay income tax on 3 lakh rupees because he has earned a income of 3 lakh rupees this year. Because in the previous year he has a loss of 2 lakh rupees, he can neutralize that. Okay, he can neutralize that. So 3 lakh rupees income this year and 2 lakh rupees losses last year. So total income would I will share my screen. Sorry. So just see. Is it audible? Okay. Just a second. Okay. Okay. So this is what we were doing. Is that audible? So this is the screen that I'm sharing. Okay. So this is the screen that I was sharing and we were discussing. Okay. So see. So once you do the adjustments, after adjustments, you get gross total income. And once you get the gross total income, adjusted gross total income, from the adjusted gross total income, we do we reduce the deductions. Okay, we claim the deductions. Now this deduction also has been covered in my last class. Okay, from section 80C to 80U. For suppose like if SSC has taken any insurance policy or contributing to any Sukanya Samriddhi Yojana or like Agniveer. So many deductions are available. Many deductions do exist, and these deductions are being availed by the SSC. So SSC generally will avail all these deductions. Okay. So this is the so once the deductions are reduced, we derive the total income. Okay, we get the total income. So see, first we need to sum up all the different means of income. Once we sum up all the different means of income, we get the gross total income. Okay, so these are the means of income for an individual: salary, house property, capital gain, business and profession, other sources. Now, sometimes students may ask, what is capital gain? In my first class, I have covered what is capital gain. Capital gain is rise in the rise in the value of asset. Okay, for example, if you sell off your property, so you might have purchased a property in 4 lakh rupees, but after 5 years when you sell, you may derive 10 lakh rupee out of the same property. So that is a gain or rise in the value of the asset. So such incomes are called as capital gains. Okay, such incomes are called as capital gain. For example, the gold which I purchased last year, the cost of the gold was 50,000 rupees. But this year, there is a rise in the prices of the gold. If I sell that gold, I would be able to derive 65,000 rupees. So that 5,000 is an income for me. So these rise of income, the rise in the price of the asset is called your capital gain. For usually shares are the best example. Okay, so there would be continuous fluctuation in the prices of the share, and that derives to a gain. So all such incomes are called as capital gains. And then people may also have income from business and profession and other incomes. Other incomes basically covers your mm, lotteries, prizes. Okay. Then we have yes. So once we get the gross total income, we do the adjustments. Adjustments basically covers your clubbing of income and set off and carry forward of losses. Clubbing of income is generally added because uh, this is this comes under the total income of the SSC, and then set off and carry forward of losses we will reduce that. And then once we do this, we derive the adjusted gross total income. And from this adjusted gross total income, the SSC will avail all the deductions. Okay, these deductions have been defined under chapter 6A from section 80C to 80U. Okay, so you can go through my previous class wherein I have taught you what are the deductions that exist from section 80C to 80U. Okay, for example, uh, pension is there, and then insurance policies are there, contribution to Sukanya Samriddhi Yojana or disability or any disabled dependent. So all such deductions are there. So these deductions are usually being availed by the SSC. Okay, so once we reduce all these deductions, we get the total income. Now, this is the income on which tax liability is calculated. Okay, on the total income, the tax liability is calculated. Now, uh, we should, this is the total income. Okay, this is the total income. Now, in order to compute the total taxable income of the SSC, one concept you must know about it is residential status, because the tax system differs depending on the residential status of the SSC. Okay, so one chapter we need to cover, that is residential status, before we come to the, before we go ahead with this. Okay, computation of total income. So once you should have some basic idea about the residential status. So let's understand what is the residential status that I'm talking about. Okay, so the mechanism of tax, imposing tax, differs based on the residential. We have residential state, like terms like okay, just give me 1 second. Okay, so determining the residential status is essential when we look for computation of total income. So see, we have resident and ordinary resident, resident but not an ordinary resident, and then non-resident. Now, how this residential status is determined? So somebody who is staying equal to or more than 182 days in a year, he is considered as an ordinary resident. Okay. And he's taxed on global income, whether he earns income from India or whether he earns income from abroad, his entire income will be taxable in India. Okay. And then we have resident, not an ordinary resident. Okay. So resident, not an ordinary residence is one who stays minimum 9 out of last 10 years. Okay. Minimum 9 out of last 10 years or 729 days, more than 720, equal to or more than 729 days in last 7 years. Okay. So he is considered as resident but not ordinary resident. So he he's he will be taxed on the income that he derives from India, and if he has any business, any income whose business is controlled from India. So he will be taxed on that income also. And then non-resident. So the non-residents will only be taxed on the income that he has from India. If he is having any income from abroad, that income will not be taxed. Okay. So this criteria you should understand. Uh, resident but resident and ordinary resident, resident, non-ordinary resident, and non-resident. This I will take it again in the next class. Okay, because that is essential in order to compute the total income and understand what worth of income is taxable, because the taxability differs depending on the residential status of the SSC. Okay. Now, once we derive the total income, the income tax law provides a provision under section 288A for rounding of total income. Okay. Now, what is rounding of total income? That is for convenience. This rounding of mechanism is being given for the purpose of convenience. For example, if the SSC total income is 6,28,454, if the last digit is less than 5, okay, if the last digit is less than 5, then this will be reduced to the nearest 10th place. Okay, this will be reduced to the nearest 10th place. That means we will write it as 6,28,450. 450. See here in red. In the red we have mentioned here. If the total income is 6,28,454, so because it is the last digit is less than 5, we will reduce this. We will reduce this to the nearest 10th place. So that is 6,28,450. Okay. In the same way, if the last digit is above 5, if the last digit is above 5, 5 or above, okay, including 5, if the last digit is 5 or above 5, then that will be brought to the next 10th place. Okay, the forward 10th place. That means, for suppose if it is 6,28,456. Okay, if it is 6,28,456, then in that case, we will make it as 6,28,450. If it is 56, we will make it as 60. Okay, so this is called rounding of total income, and this is basically for convenience, so that computation of tax liability becomes easier. That is the main motive behind rounding off, and thus rounding of total income is given under the mechanism is there in the section 288A. Okay, so if it is less than 5, it will be rounded off. It will be rounded off to the previous 10th place. Okay, it will be rounded off to the previous 10th place. But if it is more than 5 or more than 5, then it will be rounded off to the next 10th place. I will share my another screen and then we'll discuss. See. So I hope this as well is visible. So this one, okay, rounding off. See, if the total income is 6,28,455, so it will be rounded off to the next 10th place, that is 6,28,460. So this mechanism is being given under section 288A, rounding off total income. For suppose, let's take an example. If the total income is 6,28,454, so last digit is less than 5. It will be rounded off to the previous 10th place, that is 6,28,450. We will make it as 450. We'll take it back and we will round it off to the previous 10th place. In the same way, if the total income is 6,28,455, then in that case, because it is 5, last digit is 5, so 5 or above 5, we will round it off to the next 10th place. So we will make it as 6,28,460. Then total income, if the total income is 6,28,454, then we will again, because it is 54, okay, 54.99. So it is less than 5. So we'll round it off to 6,28,450. Okay. In the same way, if under section 288B, there is a mechanism given for rounding of the taxable income. Okay, rounding of taxable income is also given under section 288A. For example, if there is a total taxable income, so from the total taxable income, we add surcharge and we get the tax liability. Okay, from that tax liability, we again add health and education cess, and we derive the net tax liability. Okay, we derive the net tax liability. See, 288 talks about the section 288 talks about the 288A. 288A talks about the rounding of total income. Okay, 288A talks about the rounding of total income, whereas section 288B talks about the rounding of taxable income. Okay. Taxable total income. So here, see, once you derive the net tax liability, how it will be rounded off? Again, we follow the same mechanism. If it is more than 5, if it is 5 or more than 5, we'll take it to the next 10th place. Okay, we'll take it to the next 10th place. But if it is less than 5, then we will round it off to the previous 10th place. So that you have to understand. Okay, the rounding off mechanism you need to learn. Okay. So let me recollect everything. Let me share you everything that we have discussed. See, the first thing that we discussed is this one. This was the first thing that we have discussed, that is computation of total income. And from the total income, we do adjustments, clubbing of income and set off and carry forward of losses. So we derive adjusted gross total income, and from that adjusted gross total income, we claim as an SSC, we claim all the deductions. Deductions are mentioned in section 80C to 80U. So we derive the total income. Now from the total income, we do go for rounding off. Now section 288A talks about the rounding of total income. I told you the mechanism that is followed for rounding of the total income. If it is 5 or above 5, it will be rounded off to the next place. If it is less than 5, then it will be rounded off to the previous 10th place. Then I told you, once you derive the total tax liability from the total tax, from total taxable income, we do add surcharges. And from the surcharge, once we add the surcharge, uh, we do also add the health and education cess, and then we derive the net tax liability. So this total tax liability, this income, the tax liability is also rounded off to the next nearest place. Okay, next or the previous 10th place in the same way. Okay, if it, for suppose if the net tax liability is 6,28,460. So sorry, 450. So if it is, sorry, if it is 6,28,454. So as the last digit is 4, we will take it back. We'll round it off to the previous 10th place. That is 6,28,450. But if it is 5 or more than 5, then we will take it to the next 10th place and we'll round it off to the next 10th place. We'll make it as 6,28,460. Okay. So this is what we have learned. Now I have one more concept that has to be discussed. See, this net tax liability is the mechanism of rounding off is given under section 288B. Okay. And this is given under section 288A. This is under section 288A and that is under section 288B. Now let's go for rebate. Okay. So let's learn about the tax rebate. See, deductions are different and the rebates are different. Okay. Rebate basically reduces the final tax liability of the SSC. Okay. But in order to avail rebate, certain conditions has to be satisfied. Okay. Uh, so basically, this reduces the tax liability of the SSC. Okay. So SSC is able to enjoy these tax rebates only if he meets or satisfies the conditions. So under the old regime, if the total income is less than or equal to 5 lakh, the maximum rebate that SSC can avail is 12,500 rupees. Okay. So tax liability becomes 0 then. Okay. If his income is uh, equal to or less than 12,500. So this is see, before we go for this rebate, we have two tax regimes going on parallelly as of now. That is the old regime, which is in effect, as well as the new regime, which is parallelly in effect. So under the old regime, if the total income is less than or equal to 5 lakh, the SSC can get a maximum rebate up to 12,500. Okay. In the same way, under the new regime, if now they have the slab has been increased, the slab has been raised. If the total income is less than or equal to 7 lakh rupees, okay, less than or equal to 7 lakh rupees, then maximum rebate that the SSC can avail is up to 25,000 rupees. Okay, so up to 25,000, the final tax becomes zero. Whereas here up to 12,500, the final tax becomes zero. So you have to be quite careful here. You have to be quite careful while while taking up this in the exam, because two tax regimes are running parallelly. So under old regime, the limit is 5 lakh, whereas under the new regime, the limit is 7 lakh. Under the old regime, the maximum rebate is 12,500, whereas under the new regime, the maximum rebate is 25,000. Now, who is eligible for it? So we should know who is eligible for it. Do everyone can avail these tax rebates? Is each individual is eligible for these tax rebates? That's the question arises. Okay. So in a simple answer, I will tell you everyone is not eligible for these tax rebates. Okay. See, the condition is it is applicable for the individual taxpayers. So not the companies, not other. It is for the individual taxpayers. And he should be a resident of India. Okay. So I told you the condition, the residential status. So he should be a resident of India. So rebate is basically applied after the calculation of the taxable income. Okay, after tax calculation. And if the income exceeds this limit, for example, if the total income is above 7 lakh, then the SSC cannot avail this rebate of 25,000. Okay. So this is a very, very essential condition that your income should not exceed this limit. Okay. In the old regime, if the income is exceeding above 5 lakh rupees, the SSC cannot avail this rebate of 12,500 rupees. Okay. So the total income of the SSC has to be within the prescribed limit. If the total income of the SSC is within the prescribed limit, then in that case, the SSC has the right to avail the tax rebate. Okay. In the new tax regime, it is 7 lakh, whereas in the old tax regime, it is 5 lakh. So these figures is something where you have to put your focus and you have to remember. Okay. See here, I have given you one example as well. Okay, example of the new regime. See, basically, the tax deductions and tax rebate, everything is the students get confused between these two things. What is deduction and what is rebate? Okay. See, basically deductions are for reducing the taxable income. Okay. Deductions are basically for reducing your taxable income. Whereas a rebate directly reduces your tax. Okay. So that is the primary or that is the core difference between deduction and rebate. Okay, because students quite a time they ask, sir, what is the difference between deductions and what is the difference between the regime? Sorry, rebate. What is the difference between the deduction and the rebate? So deduction basically reduces our taxable income. Okay. Deductions are basically something that reduces our total taxable income, whereas rebate reduces the tax directly. Okay. So the which section talks about or provides you this? This is tax rebates are under section 87A. So these sections are certain things that you have to mug up. The sections you need to remember. Okay. Section 87A talks about the tax rebates. Okay. And these conditions is essential because if the conditions are not met, the SSC cannot avail these tax rebates. Only if the conditions are met, you can avail or enjoy the tax rebates. Okay, so these are the four essential requirements that he should satisfy, that SSC must satisfy. Okay. In among these four, we have this one, not applicable if income exceeds above this limit. So what is the limit? 5 lakh in the old regime and 7 lakh in the new regime. Okay. So in the old regime, it is maximum rebate limit is 12,500, whereas in the new regime, the maximum rebate limit is 25,000. So these are the things. With this, we have covered the computation part, the computation of the income. And once we go ahead from here, we have the tax bodies that we need to cover next. Okay. The different bodies that designs or that looks after the tax provisions in India. Okay. Which are responsible for imposing penalties and keeping a uh, like all the regulatory bodies that regulate the tax structure and tax mechanism in India. So we'll be covering them in the next class tomorrow. So this is what we have covered today. Computation of total income. For example, I told you, for suppose if you are a SSC, these are your sources of income. Okay. And then I told you how to do the rounding of the total income. Okay. Which section deals with this? Section 288A is 288A deals with the rounding of the gross total income or total income. Okay. If it is more than 5, then we'll take it to the next 10th place. If it is less than 5, then we'll take it to the previous 10th place. In the same way, we do it for in the same way we do it for the tax liability as well. Okay. So section 288B talks about it. The same way we do the rounding of the net tax liability. Okay. Then rebate is what we have learned. So rebates are basically to reduce the tax liabilities directly, but if the conditions are met. Okay. So which section talks about rebate? Section 87A talks about the rebate. Okay. So this is your section for rebate. Okay. So with this, we have completed most of the aspects of this. Okay. Most of the aspects we have covered. Now we have theoretical aspects in this. So once we go ahead from here, we have mostly the theoretical aspect wherein understanding is required. So in the next class, when we join, we will learn the tax bodies, the regulatory bodies, okay, mostly the bodies which deals in imposing of the provisions of the taxes, imposing fines and penalties for tax evasion and tax avoidance. Okay, so these things we will be learning from the next class. Okay, so to this extent, we have completed mostly the operational part of this subject. Okay, the first class uh, we learned about the uh, basic concepts of taxes. Second class, we have learned about clubbing of income, and third class, we have learned about carry forward and set off and carry forward of losses and gains. And today we learn computation of the gross total income and rounding of total income and taxable income and rebate.